The Fed just dropped a bombshell warning that has every American with loan and credit card debt on the edge of their seats. In a stunning and unprecedented move, the nation's central bank has signaled that the days of easy credit and low interest rates are ending. Millions of hardworking Americans could soon be drowning in debt and financial hardship. As the economy struggles to recover from the pandemic and inflation threatens to spiral out of control, this warning from the Fed is not just a wake-up call, but a dire reminder of the need for caution and prudent financial planning. If you're one of the millions of Americans struggling with debt, it's time to take action and start preparing for the storm that's coming. Don't wait until it's too late. Watch this video now to learn what you need to know about the Fed's warning and how to protect yourself from the coming financial storm. Following Wednesday's decision, the Federal Reserve raised its key interest rate by 0.25% to 5.1%. As a result, credit card, mortgage, and auto loan rates, which have already been skyrocketing since the Fed began hiking rates a year ago, are expected to go substantially higher. This would result in higher borrowing costs for both individuals and businesses. Nevertheless, many financial institutions are now offering people higher interest rates on deposit accounts. In addition, the Federal Reserve has raised interest rates 10 times since March 2022, and some economists are concerned that this might slow down economic activity significantly and lead to a recession. Although inflation has dropped over the past few months, it still remains very high. The year-over-year growth in consumer prices was 5% in March, slightly lower than the 6% increase seen in February. Federal Reserve policy reduces economic activity and inflation by dampening consumer demand for housing, transportation, and additional products and services. Fed Chair Jerome Powell has previously stated that although it may be unpleasant for consumers, quickly raising interest rates is necessary to combat high levels of inflation. Leading banks such as Wells Fargo, Bank of America, JP Morgan Chase, and Citibank have been taking proactive measures to mitigate potential fallout from the ongoing economic downturn caused by the COVID-19 pandemic. These institutions recognize that a significant percentage of their customers may struggle to keep up with their loan and credit card payments due to financial hardship from the crisis. As a result, these banks have anticipated a probable increase in default rates for loans and credit cards, which will further exacerbate the impact of the economic downturn. As a result, these banks have created loan loss reserves to preempt any potential liquidity issues. Banks utilize loan loss reserves as a financial mechanism to safeguard themselves against potential loan defaults. This involves setting aside funds that can be used in case of loan or credit card account losses. This allows banks to compensate for the loss in revenue that would arise from non-payment or delinquency. These banks are reserving billions of dollars to cover potential loan losses, significantly increasing scrutiny of loan applications and scrutinizing creditworthiness more carefully. By taking a proactive approach, these institutions are working to ensure their own financial stability while maintaining the trust and loyalty of their customers amidst ongoing economic turmoil. The central banks have made a strategic decision to reserve billions of dollars, anticipating an impending economic contraction. This decision suggests that they have gained crucial insights into the current economic situation and identified concerning trends that could impact the global economy. A prime indication of an economy slowing down is the short-term interest rates the Federal Reserve has set over the past 1.5 years. This factor poses a substantial threat to the economy, and the fact that the banks are hoarding their resources suggests a possible financial meltdown. However, despite these troubling revelations, some hope remains in the form of a thriving labor market acting as a buoy for the economy. Nevertheless, the economy will likely plunge into a recession if the unemployment rate increases and people start losing their jobs. In such a scenario, the 4 major banks that are too big to fail will most likely experience delinquencies in their loan portfolio and credit card portfolios, since their clients will no longer be able to repay the loans owed to the banks. Therefore, it is evident that banks have gathered critical information about the current financial landscape and are proactively taking measures to mitigate the looming risks. By stashing billions of dollars, they are guarding these assets against an impending economic contraction and preparing for great uncertainty. Naturally, it is yet to be determined how the situation will unfold. Still, one thing is certain: banks will be at the forefront of any significant economic shifts, and their actions will have far-reaching consequences for all stakeholders involved. Please take a moment to hit the like and subscribe button if you are enjoying the video so far. In order to mitigate the risks posed by an economic downturn, central banks are taking action and raising interest rates. Lowering inflationary pressures can potentially lessen the impact of a recession. Nevertheless, interest rate hikes may be unpleasant for consumers, but they are necessary to control excessive inflation. In addition, governments across the world have been implementing fiscal policies to contain the crisis. These measures comprise tax relief for businesses, an increase in government spending, and individual subsidies, which will help provide a much-needed cushion to the global economy as it attempts to navigate choppy waters. People looking for financial assistance to make a significant purchase, such as a house, a car, or even an appliance, are expected to face the financial burden caused by the recent increase in interest rates. As a result, monthly payments and costs are also expected to escalate for people already burdened with interest on credit card debt. In such a scenario, banking and financial experts recommend prioritizing the establishment of a robust emergency fund and repaying existing debts. According to Greg McBride, chief financial analyst, these measures will be beneficial even if this rate hike is the last. The current interest rates in the market are still considerably elevated and are expected to continue in the same manner. Therefore, consumers must remain diligent and try to reduce their debts, increase their savings, and stay informed about the economic status quo. Prior to the most recent action taken by the Federal Reserve, credit card borrowing had surged, reaching its highest point since 1996. Recent data revealed that 46% of people cannot pay off their credit card debt at the end of each month, representing a significant increase from the 39% observed merely a year ago. According to some figures from the Fed, total credit card balances rose to an astonishing $986 billion in the fourth quarter of 2022, reaching an all-time high. However, it is important to acknowledge that this amount has not been adjusted to account for the impact of inflation. Moreover, those who fail to meet the minimum qualifications for low-rate credit cards due to their subpar credit scores are already starting to feel the consequences of the elevated interest rates on their outstanding balances. How might this impact home ownership? The recent report by mortgage buyer Freddie Mac revealed a slight increase in the average rate on the 30-year mortgage benchmark from 6.39% to 6.43%. This marks a notable difference compared to the average rate of 5.1% a year ago. An increase in interest rates can lead to an additional financial burden for homeowners, resulting in a rise of hundreds of dollars in monthly mortgage payments. The fluctuations in rates for the 30-year mortgage debt instrument typically mirror the rise and fall of the 10-year Treasury yield. However, investors' expectations of future inflation, the global demand for U.S. Treasury bonds, and the Federal Reserve's decisions, among other factors, can also shape the interest rates movement. These factors can significantly impact home ownership, making it a significant concern for those planning to purchase or refinance homes. For many people, purchasing a home is a significant milestone that requires careful planning and consideration. Nonetheless, the recent surge in prices of fundamental commodities such as fuel and food has made the prospect of owning a home an even more challenging endeavor. In addition, higher mortgage rates could make it even more difficult for prospective homeowners to achieve their dreams. With the steady rise in consumer debt, many Americans rely heavily on credit to make ends meet. For example, a recent survey by Experian revealed that nearly 40% of respondents have turned to at least one form of credit to cover their expenses during the COVID-19 pandemic. This included taking out personal loans, using a credit card, or even tapping into their retirement savings. Low-income households have been increasingly dependent on credit. For example, a survey by the Federal Reserve found that 41% of adults earning less than $40,000 a year have used credit to cover their expenses at some point during the pandemic, in which they are still feeling the effects of. This is significantly higher than the 28% of those earning more than $100,000 who reported using credit due to financial difficulties. The heavy dependence on credit has taken a toll on many Americans' finances. Higher interest rates associated with some forms of credit can make it even more challenging to pay off debt, resulting in additional costs that strain individuals' budgets. Furthermore, a growing reliance on credit over the long term can lead to an increased risk of financial difficulty. Therefore, those living off credit must try to use it responsibly by paying off their monthly balances. Additionally, people should take proactive steps such as creating a budget or looking into debt relief solutions to ensure they can remain financially secure over the long term. Taking this step can minimize the likelihood of accumulating additional debt and offer financial security during times of economic uncertainty. The real question is, when will the Fed and the government do something that actually helps the people instead of continuing to hurt its people for their financial benefit? Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.